At first glance, Binance looks like the ultimate crypto success story, a company that rose from nothing to dominate the entire industry in just a few years, processing more trading volume than almost every other exchange combined. It has no headquarters, no public financial statements, and no clear regulatory home. Yet it moves more money every day than many national stock markets. But the crisis facing Binance is not a single lawsuit or one dramatic collapse. It is a slow, structural breakdown happening quietly in the background. A crisis of trust, regulation, and internal fragility that most users do not see because the platform still works and withdrawals still go through, for now. The story begins with Changpeng Zhao, known simply as CZ, a developer who moved through several jobs in traditional finance before discovering Bitcoin in 2013. He quickly became convinced that centralized exchanges would be the backbone of the crypto economy. But the early platforms were fragile, slow, and frequently hacked. CZ believed he could build something faster, cheaper, and more resilient. In 2017, he launched Binance at the height of the first major crypto boom. Timing was everything. Binance arrived just as retail investors were flooding into crypto, looking for easy access and speculative gains. The platform offered hundreds of tokens, low fees, and an interface that favored speed over caution. While competitors struggled with outages, Binance scaled rapidly, adding users across Asia, Europe, and Africa within months. It became the largest exchange in the world, not by being safer, but by being more permissive. From the start, Binance operated in regulatory gray zones. It avoided fixed headquarters and moved its legal entities frequently. When one country introduced stricter rules, Binance simply shifted operations elsewhere. This flexibility was praised by crypto enthusiasts as decentralization in spirit, but in practice, it meant no regulator truly oversaw the company's internal controls, its custody practices, or its financial health. Binance also created its own token, BNB, which initially functioned as a fee discount mechanism, but gradually became something much more important. BNB was used for transaction fees, staking, governance, and collateral across Binance's growing ecosystem. As the token's price rose, so did Binance's apparent balance sheet strength, even though the value depended entirely on market confidence and continued trading volume. The company expanded aggressively, launching futures markets, lending products, yield programs, and its own blockchain. All of these systems fed into each other, creating a closed financial loop where user funds, tokens, and leverage were constantly recycled. The business model relied on volume, not stability, and growth, not resilience. Unlike traditional exchanges, Binance never published audited financial statements. Customers could not see how reserves were held, how much leverage existed, or what relationships Binance had with affiliated trading firms. The platform claimed to hold user funds one-to-one, but proof of reserve snapshots were partial and did not show liabilities. This meant users could not verify whether assets truly existed or whether they were encumbered by hidden obligations. As crypto markets matured, regulators began paying closer attention, and Binance's structure became a liability. Banks were pressured to cut ties, payment processors withdrew support, and governments demanded compliance with anti-money laundering and securities laws. Binance responded by promising reform, hiring former regulators, and creating compliance teams, but the underlying structure remained opaque. The crisis deepened when investigations revealed Binance had commingled operations across jurisdictions and entities. Customer funds moved through complex networks of wallets without clear separation between corporate and client assets. While Binance denied misuse, the lack of transparency meant there was no independent way to confirm this was the case. At the same time, competitors collapsed, revealing systemic weaknesses across the industry. FTX, Voyager, Celsius, and BlockFi all failed after using customer funds for risky internal activities. This forced users to ask the same question about Binance. If everyone else was lying, why should the biggest player be different? Confidence is the only real asset of an exchange, and Binance's confidence began to erode when withdrawals spiked during market stress events. Large sums left the platform within days. Binance processed them successfully, but the episodes exposed how fragile perception can be in a market built entirely on digital promises. Binance's biggest problem is not insolvency, but jurisdiction. Without a clear home, it cannot be fully regulated, but also cannot be fully trusted. No authority can guarantee its practices, and no court can easily enforce accountability. This makes Binance uniquely powerful and uniquely vulnerable. Internally, the company depends heavily on CZ. His control over strategy, culture, and decision-making remains centralized, despite public claims of decentralization. This creates a single point of failure. If leadership credibility collapses, the entire system is at risk. Another silent crisis lies in market structure. Binance dominates trading pairs, liquidity, and token listings. This gives it enormous power to shape which projects succeed or fail, but also means it carries systemic risk. If Binance stumbles, liquidity across the crypto market could evaporate almost instantly. Regulatory pressure continues to build. Lawsuits, fines, and bans accumulate across multiple countries. Each one alone is survivable, but together they form a slow tightening noose, limiting access to banking rails and institutional clients. At the same time, Binance's token, BNB, remains critical to its ecosystem, but its value depends on user confidence and ongoing activity. Any sustained decline in volume or trust weakens that foundation, creating a feedback loop similar to other collapsed platforms. The public crisis is always dramatic: arrests, bankruptcies, sudden shutdowns. But the Binance crisis is quiet. It unfolds in audits not published, bank partners quietly leaving, and legal filings most users never read. It is a crisis of structure rather than spectacle. The real danger is not that Binance will disappear overnight, but that it will slowly lose legitimacy as regulators close in and institutions retreat, leaving only retail users exposed in a system with diminishing safeguards. If Binance fails, it will not be because of one trade or one scandal. It will be because a company built to avoid rules eventually ran out of places to run from them, and because trust, once questioned, never fully returns. Binance's story is not yet finished, but the warning signs are already written in the history of every exchange that believed scale could replace transparency and speed could replace governance. The crisis no one is talking about is that the foundation was never as solid as it appeared.